There's a lie you've been told your entire life. It's a lie so big and so common that we've accepted it as a fundamental truth of personal finance. The lie is that a savings account at your bank is a safe place to keep your money. That sounds right, doesn't it? It feels safe. It feels responsible. But what if I told you that this safe place is actually a guaranteed way to lose money every single day? What if I told you that your bank is legally, systematically, and intentionally making you poorer? This isn't a conspiracy theory. This is just math. Let's do a quick calculation. Imagine you worked hard and saved up $10,000. You do the responsible thing and put it in a savings account at one of the big national banks. You check back in a year. The bank, in its infinite generosity, has paid you about 0.4% interest. Your account now has $10,040. You made 40 bucks, right? Wrong. During that same year, inflation, the rate at which prices for everything go up, was around 3.5%. This means that the stuff you could buy with $10,000 last year now costs $10,350. So while your bank statement says you have more money, your actual purchasing power, what your money can actually buy in the real world, has gone down. You didn't make $40. You effectively lost $310 of real-world value. And the craziest part, the bank did this to you completely legally. This isn't a flaw in the system. This is the system. And today, we are going to expose how it works and, more importantly, how you can fight back. To really understand what's happening, we need to pull back the curtain on the psychology and the mechanics of the modern banking system. Why do we all fall for this? It's because we're conditioned to. From the time we're kids getting our first piggy bank, we're taught the mantra, save your money, put it in the bank. It's the safe thing to do. Your parents told you this, their parents told them, and the banks spend billions of dollars on advertising every year to reinforce this message. They show happy families buying homes, smiling retirees on a beach, all powered by their friendly neighborhood bank. They talk about FDIC insurance, which guarantees your money up to $250,000, and that part is true. If the bank fails, you won't lose your initial deposit. But they conveniently leave out the fact that while your principal is safe from bank failure, it is completely exposed to the silent, relentless erosion of inflation. FDIC insurance protects you from a loud, dramatic bank run. It does absolutely nothing to protect you from the quiet, guaranteed loss of purchasing power that happens every single year. It's a security blanket designed to make you feel comfortable while your financial future slowly suffocates. Let's talk more about that first thief, inflation. I want you to think of inflation as a leak in a bucket. Your money is the water in the bucket. Every year, inflation pokes a new hole in that bucket, and your purchasing power starts to drain out. A 3% inflation rate means your bucket is losing 3% of its water every year. The interest your bank pays you is like trying to refill that leaky bucket with an eyedropper. It's a losing battle. Let's look at the real numbers over a longer period, because this is where it gets truly terrifying. Let's stick with that $10,000. If you leave it in a standard savings account earning a pathetic 0.4% for 10 years, you'll end up with about $10,408. It looks like you made a little money. But let's assume an average inflation rate of just 3% over that decade. To have the same purchasing power as your $10,000 today, you would need $13,439 in 10 years. So, you have $10,400, but you need over $13,400 just to break even. You are $3,000 poorer in real terms. You worked hard for that money. You saved it, you did the responsible thing, and the system punished you for it. The money you saved for a down payment on a house, for your child's education, or for your retirement is actively being devalued just by sitting where you were told to put it. This is the part that should make you angry. It's the part that made me angry when I first understood it. But it gets worse, because inflation is only the first thief. The second thief is the banking system itself, and this is where we get into the legal robbery part of the equation. This is the secret of how banks actually make money. When you deposit your $10,000 in the bank, what do you think happens to it? Most people imagine it goes into a little digital vault with their name on it, just waiting for them when they need it. That is not what happens at all. Your money doesn't sit there. The moment you deposit it, the bank sees it as a liability. They owe you that money, but it's also an asset they can use. Thanks to a system called fractional reserve banking, your bank is only required to keep a small fraction of your deposit on hand. The reserve requirement has fluctuated, but let's use a classic example of 10% to make the math simple. So, of your $10,000, the bank might keep $1,000 in reserve. They then take the other $9,000 of your money and they lend it out. They lend it to someone else as a car loan at 8% interest. They lend it out as a mortgage at 7% interest. They lend it out on a credit card at a staggering 22% interest. They are using your capital, your hard-earned money, to generate massive returns for themselves. They might make, say, an average of 8% on that $9,000 they loaned out. That's $720 in profit for them in the first year alone. And what do they pay you for providing them with the raw material for their entire business model? They give you that insulting 0.4%. They made $720 using your money and they paid you $40 for the privilege. They are literally arbitraging your life energy. You trade your time for money, you give that money to the bank for safekeeping, and the bank uses it to make themselves rich while paying you a fee that doesn't even keep up with the cost of living. You are not their customer in the traditional sense. You are their product. Your deposits are the product they use to generate loans and profits. This is the core of the issue. You think you are a saver, but in the eyes of the banking system, you are a lender. You are lending your money to the bank for an interest rate that is almost zero. You are taking on all the hidden risk of inflation, while the bank takes your capital, leverages it, and reaps all the rewards. It is the single greatest transfer of wealth from the public to a financial institution, and it happens millions of times a day, every single day. So, if leaving your money in a savings account is a guaranteed loss, what are you supposed to do? Shove it under the mattress? Of course not. That's even worse. The answer isn't to abandon the system entirely. The answer is to understand the system and use it to your advantage. Instead of letting it use you, you have to change your role in the game. You have to stop being just a lender and start becoming an owner, and it's not as complicated as it sounds. It comes down to understanding that different types of money need to live in different places. You wouldn't store ice cream in the pantry, and you shouldn't store your long-term wealth in a savings account. We need to give our money the right home for the right job. So, let's recap the truth. The idea that a savings account is a safe haven for your wealth is the biggest lie in personal finance. It's a parking lot where your money's value is guaranteed to be eaten away by the twin thieves of inflation and a banking system designed to profit from your capital. They use your money to make a fortune and pay you pennies, all while the real-world value of your savings evaporates. The system is not broken. It was designed this way, but you don't have to be a victim of it. You can choose to play the game differently. Here are the 3 simple things you can do today to take your financial power back. First, you need to segregate your money and give it a purpose. Not every dollar you have is the same. You need to divide your money into 2 main buckets: your emergency fund and your investment capital. Your emergency fund is your safety net. This is 3 to 6 months of your essential living expenses. This is the money that protects you from a job loss, a medical emergency, or an unexpected car repair. This is the only money that should be focused on safety and immediate accessibility over growth. Everything else, every single dollar beyond that emergency fund, is your investment capital. Its job is not to be safe. Its job is to grow. Its job is to work for you and build real wealth. Second, for your emergency fund bucket, you need to get it out of your brick-and-mortar bank savings account immediately. You need to upgrade its home. You're going to move it into what's called a high-yield savings account, or HESA. These are typically offered by online-only banks. Because they don't have the massive overhead of physical branches and thousands of employees, they can pass those savings on to you in the form of much, much higher interest rates. While a big bank might be paying you 0.4%, a good HYSA today might be paying you over 4%, sometimes even 5%. That's literally 10 times more. Now, is it beating inflation? Some years, yes, some years, no. But the leak in your bucket just went from a fire hose to a tiny drip. This is the smartest, safest place for your emergency fund. It's still FDIC insured, it's still liquid, but it's fighting a much better fight against inflation. Third, and this is the most important step for building real wealth, you must put your investment capital to work. You need to change your role from a lender to an owner. Instead of lending your money to the bank for fractions of a percent, you are going to buy assets that grow faster than inflation. The simplest and most effective way for most people to do this is to invest in a low-cost broad market index fund, or ETF, like one that tracks the S&P 500. Don't let the jargon intimidate you. All this means is that with one purchase, you are buying a tiny piece of the 500 largest, most profitable companies in America. You become a part owner of Apple, of Microsoft, of Amazon. When the economy grows, when these companies innovate and make profits, you, as an owner, share in those profits. Historically, the average annual return of the stock market has been around 10%. Compare that to the 3% inflation rate and the 0.4% your bank gives you. This is how you build wealth. You own a piece of the engine of economic growth. The system isn't going to change for you. You have to change your relationship with it. See your bank for what it is: a place for transactions, a place to pay your bills from, and nothing more. It is not a place to store your wealth. Your wealth belongs where it can grow and compound. Stop being a lender to the banks. Start being an owner of the economy. That is the secret. That is how you reclaim your financial future. If this video opened your eyes, do me a favor and hit that like button and subscribe for more financial truths they don't teach you in school. And I want to hear from you. Leave a comment below. What was the most shocking thing you learned about how banks really work? Thank you for watching. I'll see you in the next video.